Big week for earnings coming up. 3M, Apple, McDonald's, Tesla, Amazon, and Facebook. Just some of the big names. And joining us now is Phil Orlando. He's the Chief Equity Market Strategist at Federated Investors. Nice to see you this morning, Phil.
Thanks for having me back.
How do you feel about the markets?
Well, we're feeling pretty good. We had a 3,100 forecast for last year. We ended up at 3,200. We thought the rally would continue this year at 3,500. On the S&P, we're now north of 3,300. So, you know, what we thought was going to be a nice sort of 10% year, we're almost there. We've only got about 5% left. So that sort of raises the prospect, as Mike talked about, that there may be a correction in the offing at some point, middle of the year. Plenty of things to talk about from a volatility standpoint, but we still think that by the end of the year, we will have, punched a positive ticket, with that number being up somewhere between 8 to 12%.
So this was an interesting week in terms of commentary we heard about the market. Paul Tudor Jones out in Davos told the Squawk gang, markets feel a little crazy, a little bit like 99. Mark Cuban told me the other day, frothy, you can make that case, but 99, no. What do you think?
Well, I think the choice of that date is very interesting, because as we got into the blow-off of the tech bubble and whatever, stocks valuations were much higher, and interest rates and inflation were much higher. So we're sitting in a situation here, core PCE sitting at 1.6%, Treasury yield sitting at 175. It's perfectly appropriate that stocks are trading at 18 times earnings. The situation then is multiples were 25 to 30 times earnings, and
if they had any. Yeah,
right, the sock puppet, et cetera. You had Treasury yields are up around 6 or 7%. Inflation, was up around 3%. So the stock market was 50% overvalued in our view then. At this point, we think shares are fairly valued. And if we get the earnings improvement we expect this year, something in the 8% neighborhood or so, that will allow stocks to grind higher over the course of the year.
What do you think the biggest risk right now to the rally is? Cramer last night had a list on his show, maybe 4 or 5 things. And among those was Apple. Apple reports earnings this coming week. And I'm just wondering what kind of pressure you think is on the market at large because of Apple, how big it is, how much it's gone up, how widely held it is, how much it means to the market. That if Apple disappoints, could that be the match that sparks a pullback of magnitude?
So the piece that I wrote this week listed 3 sort of near-term concerns. Apple was not on that list, but theoretically it might be, given one of the risks is the coronavirus as we're heading into the Chinese New Year period. Now, the tech companies, particularly Apple, the consumer-related companies, do very well during this period with the Lunar New Year, because a lot of new technology, new phones are purchased. If there's a significant decline in confidence based upon what's going on, maybe that has a deleterious impact on sell-through at Apple. The other 2 issues, exactly how bad are Boeing's manufacturing issues? How much does that bleed into the second quarter or the second half of the year?
That was at the top of Cramer's list.
And then the third issue is there's a lot of skepticism about what we believe will be the positive impact from the skinny Phase 1 trade deal we signed recently. There are a number of strategists and economists that are sort of poo-pooing that and don't think there'll be any economic impact. We disagree with that assessment, but if the naysayers are right, maybe that has an impact on Apple sell-through as well in Asia.
What do you see in the China trade? Because I agree with you on that one. I think there's a lot more positive there. But what are some of the specifics that you kind of identify?
There are 2 issues that we're focused on. The key element from the skinny Phase 1 deal is that we're going to get $200 billion of exports over the next 2 years, largely focused on ag. Corn, soy, and pork. The naysayers are saying that the Chinese are simply hoodwinking us into getting us to lower the tariffs. But when push comes to shove, they're not going to make those purchases. We disagree. The Chinese are in a situation where they're not doing us any favors. They desperately need the stuff that we're going to sell them in terms of the swine flu epidemic impacting their pig herd. The Chinese people eat more pork than the rest of the world combined, and as a result of the infection, they've been forced to put down more than half of their pig herd. So they need to purchase our soybeans and corn to fatten up the healthy pigs, and they need to import pork from us to meet the pork deficit that's been created as a result of that. Longer term, looking out over the next year or so, we've noticed a significant decrease in economic activity here in the United States based upon a decline in CEO confidence, a reduction in CapEx spending, and a reduction in productivity growth that we believe is tied into the negative overhang from the China trade deal. So if we've now starting to make progress on getting that deal consummated, phase one, hopefully phase two at some point in the next year or so, does that improve CEO confidence, and do we start to see an improvement in both CapEx spending and productivity growth that ultimately will lift GDP growth and corporate earnings growth?
Mike, massive week for earnings next week. How high are expectations as we go into Apple in particular?
Yeah, it seems as if the formal estimates are low enough, I think, for most companies to hurdle them. And it's been all about exactly how the stocks were positioned going into them. Apple is one where, I mean, the bar has really been pretty high, even though it hasn't been mostly an earnings story. To me, the rally in Apple has mostly been about the kind of general backdrop of extremely strong cash flow earning companies. And people are saying if this cycle lasts, we want to own this for a long period of time. We can discount those very, very many years of cash flows back. But when you have earnings come in, it kind of focuses you in on the micro. That's certainly an issue. To me, it's about, does the global upturn happen on time? Does everything going on in Asia right now mean we have to forestall it? We have now bond yields coming back down. We have a flatter yield curve. And so is the market gotten ahead of itself in terms of when the reacceleration actually occurs? That's going to be the question for the markets.